the Fed taper timeline.
Yeah, the Fed September meeting wrapped up, and the big news was that apparently the taper is going to start potentially in November, so sooner than was previously expected by the market, and it's going to wrap up mid 2022, so it's going to wrap up quicker than the market previously expected. And now the question is, are they actually going to be able to get through the taper? Is Jerome Powell going to be able to see the taper through, given that he's up for renomination next spring? And if they're going to get it done, they should go quick, because the economic data is starting to pick up, and they sort of have a short window. So there's a chance they could actually get through it.
Let's look at the next chart here, if we can pull that up, at the actual path of tapering and what the balance sheet would look like based on what we know today.
Yeah, we take a look at the Fed's assets, somewhere around $8.5 trillion right now. And then we get into the two colorful lines. So the green line is what the consensus was, what Fed assets would look like based on the consensus around the taper timeline. So that's the green. The prior projection after the June meeting was something around 15 billion in tapering per meeting. So at every meeting, there are 8 meetings in a calendar year, they would reduce the pace of asset purchases from 120 billion currently. They would reduce it by 15 billion until they got down to purchasing no new treasuries or mortgage-backed securities by the end of next year. So it was 15 billion per meeting starting in January 2022, wrap it up at the end of 2022, and we're all done. So nice and clean in the full calendar year next year. And then you'd see the Fed's balance sheet, if they were to have followed that timeline, would have topped out at something around $9.7 trillion. So in taking the punch bowl away, they're basically adding $1.2 trillion to the balance sheet. So not that hawkish. And then you see the red line, which is the updated projection after the September meeting. So much quicker. So 15 billion in tapering per month as opposed to per meeting. And then starting sooner, so starting this year, perhaps at the next meeting in November, and wrapping up mid 2022. So there you see the Fed's balance sheet tops off at 9 trillion. So 500 billion more than we're at today. So net, you're talking about the Fed getting down to 0 monthly purchases 6 months sooner than we previously thought. They're going to start tapering about a month sooner than the market previously thought, 2 months sooner. And then their balance sheet should be $700 billion smaller than investors were thinking previously. So a pretty significant change in guidance only in 3 months. And what's the Fed watching? Well, their dual mandate apparently is employment and price stability, right? And the employment data hasn't been great from June to September. But you would look at this change in projection and you would think the employment data was picking up rapidly. So they're clearly not reacting to that part of the mandate. It's more the inflation side seems to be spooking the Fed.
Yeah, it's interesting. So what's the likelihood that we're outside of those sort of guardrails on those two paths, or somewhere in between? I mean, I think a big factor, which probably wasn't a factor a few days ago, but now potentially could be a factor, is Powell's term's up in February, and perhaps if somebody else comes in who's more dovish, that this could be derailed. And I think that was a lower probability until just recently with the Fed trading issues that sort of have come to light. And what's our take on that? And where do we think that could land us here?
Yeah, if the Fed and Powell are actually going to see this through, they should go quicker and sooner, because we know there's a glut of money in the economy. The earnings trajectory is fantastic. The economic growth trajectory is fantastic for at least the next 12, hopefully 24 months. And so if the market is going to allow the Fed to taper, it's almost like you better rip the Band-Aid off, because the longer it takes, the more likely the economic boogeyman is going to pop up, and economic data is going to deteriorate. The market could have a big sell-off and the Fed would have to stop. And then also, as you were saying, if Jerome Powell's going to get this done, he might only be there until February, March time period of next year. So at that point, if he's handing over the chair of the Fed and there's only a couple months left until the tapering is complete, it would probably just get followed through by whoever came in next, as long as the economic data and the labor market data supported it.
Mm-hmm.
So there definitely is that aspect. If it's going to happen, there's probably more pressure on now to get it over quickly. And then the last part is that we have to dive into is, does the Fed feel like they're behind? Do they feel like they've been moving too slow? What are they afraid of?
Right. Yeah, it'll be interesting because I think the Biden administration will be making their nomination for either to keep Powell or to replace him in the coming months. So it probably before the tapering potentially even starts, we could know Powell's fate here. So lot to digest here in the coming weeks and months.
Mhm.
So the tapering is one element that sort of the big jump in our minds was what happened to interest rate expectations, because following the tapering there was talk about when will rates move higher, and there was a significant shift in the expectations there. And if we can throw the chart up, maybe walk us through what we saw in the expectation changes.
What the Fed and Powell have said is that interest rate hikes should not be at all dictated by the timeline of the taper. However, now that they've adjusted the timeline of the taper, it seems like the first interest rate hike is going to happen sooner. So clearly, the Fed does think they need to get through the taper and then hike interest rates shortly thereafter. So
Right.
clearly, the taper does dictate interest rate hikes. And what does the market think of all of this? That's what we see on this chart. So the green line is what the market thinks short-term interest rates are going to be over the next 1 year, 2 year, 3 year, 5 year, 7 year, 10 years out. And these numbers are struck as of July 19th. And this was sort of the depths of Delta variant, where the consensus was, economic growth is going to really disappoint and we're going to be stuck with COVID-19 forever. And this was basically the low point for the year. So the market was thinking 5 years out, maybe the Fed will get the federal funds rate up to 1.125, 1.13 if you round it percent at the end of the next 5 years. Not even up to the 2% inflation target they have.
Mm-hmm.
So basically, interest rates are going to be low forever. And then very quickly, from July to September, if you look at that 5-year number, it jumps 0.5%. So now pricing in a couple things. And this is also why we think the market reaction this time was so much different than when the Fed changed their messaging from March to June. Because the economic data is actually starting to improve. The COVID data is starting to improve.
Mm-hmm.
Economic data is starting to come in a little better than expected, or at least in line with expectations. That happening at a time when the Fed is signaling more hawkishness, that is why you got a big increase in the expectations out to the 5 years. So now 1.63%. And if you move all the way over to the 1 year, so that's in the next 12 months, you can see there's your first rate hike,
Right.
0.23%. There's your first rate hike end of next year. So the economic momentum and the backdrop during which the Fed changed their messaging, that in our view is why you got such a different market reaction.
Yeah, it'll be interesting to see how this plays out, because they're balancing that against this labor issue where labor is not recovering as expected.
Yes, great point. And the other point to that, which we definitely dig into, is out at the 5 year, well, this transitory inflationary spike should be over, right? So what are you reacting to now?
Right.
You have to be worried about something else. And perhaps you're worried about second order effects of inflation. Perhaps you're worried about labor market tightness. Perhaps you're worried about a wage price spiral. Maybe that's what the market is thinking the Fed is now more focused on, even though just 12 to 24 months ago, they reiterated multiple times that they were not worried about an inflation overshoot. They were going to let inflation overshoot, and they were comfortable with seeing wage increases.
Mm-hmm.
So once again, the Fed's saying one thing, but clearly they're doing something different.
Right. And over the next 5 years, the likelihood of us sort of facing a recession is pretty high. So
They typically happen.
yeah,
Yeah.
it'll be interesting to watch how this all plays out here. But and especially with the change in the Fed, if Powell is out, I think that could sort of throw the cards up in the air and have us sort of reshuffle our expectations going forward. Because really, the important thing is, with a lot of these members coming off now, we're going to have a different Fed going forward.
Exactly. Yeah. It looks like it's going to be far more dovish.